So now we're going to be talking about private equity and in particular, what it takes to spot the companies of tomorrow. So if our panelists would like to introduce themselves, again, if we start with Ralph first, please.
Thank you, man. Oh, that's our way, sorry. Okay. I'm not the technology guy. My name is Ralph Goes. I'm a partner and the chief operating officer at Apax. I'm in the investment committee for a listed fund, Apax Global Alpha. Been with Apax for more than 20 years.
I'm James Hart. I'm investment director at Whitton Investment Trust. Whitton, as I'm sure many of you know, has been around since 1909, and we invest in global equities, primarily listed global equities through a multi-manager approach. But we also have about 15% of our assets invested in investment companies and other funds, much of which is exposed to private assets.
Hi, Stephen Tredgett, partner at Oakley Capital. Oakley Capital is a mid-market private equity buyout fund focused in Europe. And I represent the Oakley Capital Investments here today, which is the listed UK investment company that invests just in the Oakley Capital funds.
Cool. And I should say that this panel is being sponsored by Whitton, obviously James's baby. So I'm going to put the first question to you, actually, James. So I think the question is, why would an investor want to make an allocation to private equity? And what place should it have in a normal investor's portfolio?
Well, without wanting to sound flippant, I think really the answer to that question is, why would investors not want to have an allocation to private equity? And I can think of one or two reasons that might be a barrier to entry. But if you think about returns, first of all, because investment is about returns, private equity over the very long run, if you think about 3i, established shortly after the Second World War, Apax Partners has been going for what, 50 years?
50 years.
So very long-term track records of private equity where they have year in, year out, with the odd blip, obviously, managed to outperform even the very best sectors within the listed equity space. And I looked at some numbers the other day. Even technology, which is clearly the leading sector in the listed equity space, has been matched by a large number of private equity managers. So, I mean, that's to me, that's the first reason why you'd want to be invested in private equity, because the returns are better. The opportunity set is also broader, and you are employing managers who are able to identify companies and then work with those companies to make changes to operational efficiency to really build out a good business that is fit for future. Now, in terms of what place does it have in a portfolio, at Whitton we think about building our portfolio along the lines of the way a private investor would build their portfolio. In other words, a chunk of global listed equities and then some special assets. And so for us, it's about 10% in private equity. Now, where does that sit within the overall allocation to private equity across the private investor space? Family offices have got about 20% invested in private equity. And then you look at some of the middle market wealth managers here in the UK, the ones that came out of the old-fashioned stockbrokers. The number is significantly smaller, much smaller, I mean, less than 5%. And therefore, you've got to ask yourself the question, why is that the case? And I think part of it, we'll probably go into this, but part of it is to do with the way in which they traditionally have got exposure to private equity, and that's through the listed private equity structure. But for us, we feel 10% that can swing between 5 to 15%, depending on the economic environment and the opportunity available, is about the right kind of number.
So now, when we talk about private equity, it's quite a sort of broad church thing, and I know some people have kind of fixed views on what private equity is. But maybe, Ralph and Stephen, you could just explain a bit about what sorts of things you actually invest in.
I go first?
Yeah.
Sure, I go first. So what kind of things we invest in? So we are focused on, I guess, one of the things we're typically looking for is one, founder-led businesses. So businesses where the founder has developed this business, has not had any institutional capital within that business, and that business is probably a digital disruptor. So it's not relying on market growth per se, but it's relying on its ability to capture market share. And then we are looking to back one of 4 megatrends. And these are going to sound pretty unexciting megatrends, and they're pretty mature trends here in the UK, but they are the business shift to cloud computing, consumer shift to digital solutions, the global desire for accessible, high-quality education, and then finally the kind of rising need for compliance and regulation of certain industries. Now, they all sound like they're drivers that maybe have played out a little bit here in the UK, but actually there's plenty of areas of the economy where there hasn't been a shift to cloud, or there isn't a digital solution for consumers. Plus, there are many different speeds at which European countries are maturing on these trends. For example, most of us have done, 90% of people in the UK have done some kind of e-commerce, even my mother. But in Italy, for example, only 40% of the population have done anything, an e-commerce transaction of any kind. So you can imagine the drivers there for those solutions to steadily get adopted. We own the #1 price comparison website in Italy. Fun enough, it goes 20% every year, has done for the last 10 years, as steadily, not because car insurance is going up in volume, but steadily Italians are getting used to using those kind of platforms. And then finally, the great thing about founder-led businesses or small to medium and medium-sized businesses, which seems to be a bit of a theme of today, is that there's a lot of opportunity to add value in companies at that scale, particularly if they have only been founder-owned. In 90% of the cases, we are the first private capital in. It means there's a lot of kind of low-hanging fruit for us in terms of helping with M&A, digitization, with internationalization and the like.
And Rob?
So at Apex, we are a global private equity firm. James just said, we have a track record of 50 years plus. Our approach is a very sector-focused approach. We exclusively invest in 4 core sectors, which are tech, services, healthcare, and digital consumer. Now, Apex Global Alpha, the fund that I'm speaking for today, is our listed fund and gives shareholders access to a portfolio of about 80 companies that operate in those 4 sectors. Now, these companies are mostly buyouts, sizable buyout transactions. It's private companies largely, therefore a portfolio of companies that you can't access elsewhere. Our investment strategy, and I'm happy to talk about this in more detail later on, is very much focused on a strategy where we don't want to rely on market tailwinds, but where we identify good companies in the categories within those 4 sectors that have long-term tailwinds, and then work on operational improvement, set a better company than on exit 5-7 years down the road.
And James, which sort of private equity companies do you hold?
We have a mixture. By far, the largest part of our exposure to private equity is through funds such as the 2 from here today. It's sort of middle market buyout, where that's for us, that's the sweet spot in terms of risk versus returns. And typically the guys will be looking to generate in the teens returns in terms of annualized IRRs over the long run for us as shareholders. We do also have exposure to venture cap, small amounts of exposure to venture cap. It was interesting talking about AI earlier, because obviously one of the big early winners of focus on AI has been the big listed US semiconductor and cloud platform companies. But we invest in a fund that spots IP coming out of universities across the UK and Europe. And one of the holdings that they have, this is by no means a recommendation, because obviously we're not allowed to recommend things here, but one of the holdings they have is a very interesting business called Helsing. It's an AI company focusing on defense. And for us, yes, of course, stocks like Nvidia and Microsoft and the others are the early winners in the AI allocation of capital to AI. But I think the more interesting thing is going to be those smaller companies in the future that you're only going to be able to get access to right now through venture cap and private equity. Aside from that, we have investments in private life sciences and also sustainable energy. So across the spectrum, but the large part is in the buyout space.
So what sort of company makes a good private equity investment? Do you want to take that first, Stephen?
Sure. I mean, I've referenced kind of some of those points in the previous answer I gave, in that kind of founder-led digital disruption theme, which kind of runs strong for us. And maybe if I give an example of a company to kind of bring that to life. So one, we're looking for something that's where we've got some information advantage. For us, we have expertise, particularly in tech, so kind of infrastructure services, software service, education, the full gambit of education, consumer digital and business services. A focus on education, it's one we can all relate to. And it's a sector we know incredibly well. We're one of the most experienced investors in education here in Europe. And what makes a good investment for us? One, a slightly hidden asset, like a carve out, something that exists with a much bigger firm, maybe is unloved, undercapitalized, with a founder that probably wants to do some kind of MBO. Great. Even better if that parent company is overcapitalized, like it may well be at the moment, and needs fresh equity. The founder has to be investing alongside us. So it's a profitable, fast-growing business, but they have to be in on the same terms as us and for the same period of time as us. And we've made the mistake of not being in that position, and we would now change that. The next thing is around this kind of, I talked about megatrends. So let's give you an example. So we carved out an education business out of Apollo Education in Germany. It's called IU Group, and it delivers online degrees. At the time we bought it, the online degree part of the business was small and growing, and it had a campus university. Firstly, we backed the entrepreneur who invested alongside us. Secondly, it was growing and profitable. Thirdly, the big trend that we believe this is benefiting from is an increasing desire around the world, but particularly in Germany, was for people to have higher education for the first time. In Germany, there's obviously a leaning towards apprenticeships and skill-based learning. And so there was a new cohort wanting to kind of study, but they worked, they had families, and they had cost limitations, all of which led them to an online solution being a good solution for them. So the trend, and a very strong trend, was there, and a trend we've subsequently found doesn't just exist in Germany. It's a global trend. And then what could we do to help them? They were 15,000 students, making about 15 million of EBITDA in 2018. What we did to help them was focus much more their attention on their marketing and digital marketing, and kind of help and increase their presence, and using kind of things like Google Analytics to really understand who their student base was. So we have helped them kind of reduce their customer capture, their student capture, down from 1,500 euros per student down to 750. They now have 120,000 students. 5 years later, they make over 100 million EBITDA. They are the biggest and largest university in Germany. And now, thanks to their expansion, they now award degrees in the UK, in Canada, and they're looking to be a big kind of global university.
Great. Ralph?
So, to answer that question, let me start again by, what is it that we're trying to achieve when we invest in these companies? And as I said already on the earlier question, our strategy is very much focused around operational improvements in the portfolio companies that we buy, making businesses better businesses. It's a strategy that is less reliant on market tailwinds, and therefore what we're trying to achieve is three things. The one is, I talked about the sector specialization that we have, is identify good businesses within those four sectors that we invest in, that operate in categories that have market tailwinds, but where the business isn't the finished product yet. We're not a deep value investor, we are not looking at turnarounds, but we want to look at businesses where we see a good business which has improvement potential, that operates in an attractive category, within the four sectors that we specialize in. So that's number one. Number two, during the fund's investment, what we do is we work with the portfolio companies, to lift these potentials that we've seen, buying into the business, working on operational improvement. And to do this, I'll just give you an example. We have an in-house team of 25, 30, professionals, which are functional specialists. It's an operational team, they bring operational expertise to the table. They also use, proprietary data platforms, to help us in decision making, around these improvements. So the second is, what we're trying to achieve is during the ownership phase, essentially, lift these operational improvement potentials that we've identified. And then third, obviously, once we've done that, crystallize that value by selling, what is a better business on exit than, what we bought on entry. Now, let me also give you an example here, just to bring this to light. And the example I want to use is an investment that we've done a couple of years back in a software business, which at the time was a subsidiary of Accenture. And that the business is called Duck Creek, US business. Our tech team, software experts within our tech team have identified that subsidiary as an Accenture, saying it's serving a huge market, which is the insurance market, by providing high quality, good quality software products. But it was like, a small subsidiary within the big Accenture corporate. So, what we've done, was a proactive approach to Accenture, was a proposal to carve out that business. Accenture reinvested in the deal, when it then happened in almost 2016. Now, what the thesis for us to do this, and this goes back into, identifying good company, in an attractive sector, which you can improve, was that it was a good company. They had good products, but it was like, it didn't fully realize the potential it had, and there was a perspective that it could grow like a market-leading, SaaS business serving a large insurance market by developing this company on an independent basis. So acquired it, carved it out, and then worked on these operational improvements that we saw. I mean, strengthened the team, strengthened the management team. We had to completely set up this company as an independent company outside of Accenture. Brought in a CTO, strengthened the leadership. We transitioned the whole model of the business towards SaaS. We doubled down on sales and marketing efforts, so invested in sales and marketing. Put in additional cost in the first step, to do this, to accelerate growth. We expanded the system integrator partnerships. As you might imagine, this business previously being with an Accenture, they were quite limited to Accenture as a systems integrator. It being an independent company, we could strengthen the go-to-market approach, and then also execute it on M&A. The business was then listed in 2020, so 4 years into the Apex Fund's ownership. It was taken public at NASDAQ. And then earlier this year, we sold the business in a take-private transaction to Vista. It returned 5.2 times gross as an investment. So it was a very successful investment for the funds and for Apex Global Alpha. Also, the take-private in January was done at a 57% premium to the year-end public valuation, a completely separate topic in terms of valuation levels that we've seen in public versus private market. So, what makes a good investment for us, as I said, from a strategy perspective, it's this combination of an attractive category in the 4 sectors that we know extremely well, track record of 50 years in those. One where we are buying a good company where we can improve the business, and 3, then realizing that the benefits of it, when we sell it, and obviously not Duck Creek. The reason I'm using it, ticks a lot of these boxes. Not all investment tick these boxes. Sport in a bilateral transaction was a carve out. There was a wide range of value creation levers that we could work on. Completely changed the business, and then obviously had a very attractive exit in the first step, through an IPO and then to a take private. But that's like the model deal we're trying to do.
Great, thank you. I think there's still a perception in some people's minds that private equity is all about financial engineering and lading things up with debt, and high interest rates are a problem. James, do you want to maybe say something about why that isn't necessarily true?
Well, looking at it from our perspective, you know, it's very dangerous to make a generalization about the private equity sector, because as we've heard already today, you know, you go right the way from pre-profit growth companies in the venture cap space all the way through to large leverage buyouts, which we're not really talking about today. The important thing, and yes, debt is part of the transaction. I'm sure the guys will add more to this, but you know, debt is normally part of the transaction. But the important thing is identifying good businesses. The examples that Steve and Ralph have given are clearly businesses that are operating well already. They're generating positive cash flow. You know, they're businesses that can be improved, but actually, it's not about buying a business and leveraging it up and then selling it on. It's about buying good businesses that can stand that sort of environment.
And
maybe I can just add on to this, and you know, I don't think Stephen nor I have mentioned the word leverage once, you know, when we talked about those two examples. And you know, I think this just illustrates that 25 years ago, probably the buyout model was very much around, you know, being able to structure a deal. Nowadays, the way our firm works, it's fair to say, also it works a very, very different approach. And the value generation isn't coming through financial engineering. The strategy that we deploy, just talked about, inherently relies on less leverage. If I look at the private equity portfolio, those 80 companies that we have in Apex Global Alpha, the average leverage level is 4.4 times. So it's very modest. Yes, obviously you use leverage to enhance returns for investors, but you know, value isn't coming, you know, by purely levering companies. You have to do a lot more to the businesses, you know, to drive value for your investors.
Yeah, and maybe just to kind of underline Ralph's point, I'm sure they're very similar stats to Ralph. So if you took our realized returns to date for all the companies that we have sold, and that's about 70% IRR, of those returns, 2/3 of those returns were generated by organic earnings growth. 1% was achieved as a result of using debt in those transactions.
yeah, I think that underlines it quite neatly. I suppose that we have seen a widening of discounts. One of the things that was talked about, especially last year, was whether the NAVs were accurate. Do you want to talk a little bit about valuations and how confident you are now where they're okay now?
Yeah, I mean, this is one we could talk on for discounts and valuations. How long have you got? I'll kick off with a few. I mean, obviously, we're going to say we're confident in them, aren't we? And there's obviously a lot of proof points to back that up. You know, we're going to trot out the same things you've heard a million times. You know, look at our realizations; they happen at significant premiums to our holding values. Our performance fees are only both based on our realized returns. So really, we're very, very little incentive for us to hold assets at the wrong price. We follow quite strict guidelines in PE. I'm sure it's the same for Apax will follow them. These IPEV guidelines, which are very clear, the appropriate way to value companies. And you know, most of the industry in the buyout space kind of follows that as well. There's also the fact that, you know, kind of we have a valuations team completely separate from the investment team. So they don't have any incentive, far less incentive investment team might have, as to start, you know, kind of showing progress in evaluation. Secondly, you know, we then have it audited. Then we have an independent valuation for the listed trust. So they get their own version of the valuation as well, which they can interrogate accordingly. James has a great line on valuations, which maybe I'll leave to him in a second. But we do slightly take the view that the real certainty comes with a private asset is when you buy it and when you sell it. Okay, and I understand in the meantime you are speculating, and we tend to take the view that because a lot is it's months and months and months of work on a business before we buy it. The level of fees and cost and manpower that's required to do that. And so when we get a valuation, we're pretty confident about that valuation. What tends to happen is, unless something fundamentally is not working with that company, we stick to that multiple, regardless of maybe what's happening in the wider market. And so you tend to find for the first 12 months, no valuation change whatsoever. And so in the first year. In the next couple of years, you might see the valuation grow only on the basis of the EBITDA growth. And then in that kind of fourth year of a typical ownership period for a PE fund is 4 years, then you might start to let the line out as you now know the market you're about to sell the asset into, and you can start to show the multiple expansion that hopefully you've created as a result of improving the quality of the business. Of course, none of that holds if the business doesn't perform. On the basis of it does perform, generally speaking, as an industry, we are pretty conservative about how we value our businesses.
Go on then, James.
No, we were discussing this before, and I think, taking what Stephen's saying, there is a science to the valuations, but there is also an art. And so my comment was that the only time you know your true net worth is when you divorce and when you die. And I think that's true also of private equity. The only time that you really know the real value of the company is when you buy it and when you sell it. There is no incentive to overvalue a holding in the intervening period. In fact, there should, in a way, there should be a disincentive to undervaluing it, because if you go back a decade, there's a real case point here, and that's Electra. Electra private equity made a big thing about the fact that they were incredibly conservative on the valuations of the companies in their portfolio, to which everybody said, well, that's fantastic, brilliant, because we'll get the upside when those positions are sold. Well, actually what happened is that somebody came along and said, well, I believe that portfolio is worth significantly more than it's being valued at, and therefore I'm happy to pay closer to NAV for it. And so, of course, everybody that was holding Electra, when it was trading at a 20 or 30% discount to asset value, said, brilliant, it's yours. And of course, they missed out on the fabulous upside that was generated when the purchaser liquidated the companies in the portfolio. So I'd argue that while it's always important to be conservative, it doesn't pay to be over conservative.
Let's hope that doesn't happen again.
To Electra, unlikely.
Well, not next to another good priority fund. Ralph, what sort of uplift do you get when you do your exits?
So if you look back over the last buyout fund generations, uplifts have consistently been in the 20 to 40% range, 20 to 50% range on the higher end. And this is across a number of buyout fund generations. Just to those points, and I agree with all of them. I think there is we can make all these arguments and say the valuation approach, the methodology. I mean, we're using largely a comps-based approach. I think there is a job though for us to do, is to create the transparency. I mean, this can't be perceived by investors as there's just a number that's popping up somewhere, which then just ends up in the accounts and presentations. But I do think as a listed private equity company, we need to create the transparency with the investors to say, this is how we value the companies. In our case, it's a comps-based methodology. We love the transparency, we love the robustness. We've gone so far that we've provided breakdowns of our NAV to say, by bucket exactly how those companies are valued, disclosing closing valuation reports. So beyond the arguments for us to say why valuations are transparent and should be robust, I do think we need to take it as our job to create this transparency to make sure investors understand how it's being done, what we do.
Cool. I've been monopolizing the questions, so we should invite some questions from the audience here. Great. Do you want to press the button on your mic, please?
Hi. I wonder if you could talk a little bit about how the private equity industry is going to access capital in this period of higher for longer rates.
Let's go first.
I'm happy to go first. I mean, I guess so far so good. I guess is the we've been successfully raising funds. We've raised close about 5 billion of fresh commitments into funds. So from that perspective, it's going well. And then in terms of accessing liquidity from a kind of debt market perspective, then for the right companies, there is still liquidity at a kind of acceptable rates. I think the fact that the rate cycle is now, kind of largely seem to be topping out. That's helping kind of lenders start to lend more. And then I guess the other side of the equation is proceeds and our ability to kind of realize that for the activity to kind of continue. And not all areas of the market for activity have clearly opened up, but in the areas where we typically hunt in the kind of lower mid-market, there's actually quite a lot of activity. And in terms of realizations, we've had a significant realization this year, which would imply that there's still plenty of dry powder within PE, and we expect to do a further 3 realizations at attractive prices over the next 6 to 12 months.
The questions around like availability of capital for ourselves and also that capital, I'd echo this. I think the private equity it's a long-term business, and once obviously have cyclicalities in terms of how people commit to the industry. Firms like ours, we continue to have success and raise the capital that we want to raise. On the debt side, again, echoing this point, I think what we've seen is that even in the current market environment and looking back over the last 12-18 months, and if you look at our business, we were never in a situation where we couldn't do a deal because we weren't able to raise the debt. Shouldn't forget that there is a whole new class of leverage providers that came into the market over the last couple of years, which is private credit, who've stepped into the gap that a lot of the banks opened up when they stopped essentially underwriting deals for syndicated loans. With our transactions, we were working a lot with these private debt and private credit providers over the last 12 to 24 months.
Cool, thank you. Anything else?
Hi. As a family office, we are making significantly larger commitments to private equity. I understand there is a cycle of making the investment and realizing it. In the interim, how are you all benchmarking your performance, say, versus the larger private equity industry performance? Is there any insights on that?
Okay, first one.
Sorry, the question is how we are benchmarking our own performance against private equity. Look, there is a number of benchmark providers out there, who measure the performance here, which I think are they will this information to you and to other investors. For us, we are driven by delivering on our investment strategy and thereby driving the returns for our investors. It's less of a benchmark driven approach. Obviously, we try and deliver the best returns, but it's much more a focus on delivering on an investment strategy and being disciplined around your investment strategy. And I talked about what this means for us, rather than being overly focused on benchmarks and trying to manage what's benchmark.
That's sensible things about. I mean, it's not an industry that typically looks at benchmarks. We're made aware by our, the investors in the funds how we're doing compared to others. And if you're not, top decile, top quartile, you're going to soon know about it, and then you will struggle to access capital. We again have an absolute return target regardless of the wider market. So for every investment we make, the minimum net return I have to make is 2 times money, for 25% IRR. And so that's what we're working towards. We hope to achieve much higher than that, but we model assuming a recessionary environment with low liquidity and maybe poor M&A opportunities. And in that environment, we have to make it 2 times money. Thereafter that, you obviously, as Ralph said, pushing for the best returns you can achieve.
I'll just add to that, James, because obviously the question was focused at private equity at the top level. But obviously, we invest in private equity primarily through the listed private equity structures. And so there are different benchmarks that you might want to apply to that. And so, for example, when we make an investment into a listed private equity vehicle, we think about the alternative uses of our capital. And the alternative uses of our capital is to buy listed equities. So for us, our benchmark is we're giving up some liquidity even though these funds are traded on the stock exchange, they're less liquid than much of the rest of our portfolio. So we're giving up some liquidity. So we want some return premium ahead of that. So, you know, we're thinking if listed equities are generating somewhere in the high single digits in terms of annualized returns over the long run, we're thinking we want good double-digit returns from our listed private equity holdings. Now, obviously, that's on the NAV basis. And James, you mentioned discounts earlier, which is the elephant in the room in terms of listed private equity. It's all very well as a shareholder seeing the NAV going up by 15% annualized over a 10-year period. But if the share price has gone from a premium to a 30% discount, then your journey is a little different. So that's where we need to start thinking about how we measure the performance of the funds that we're invested in, as well as the performance of the board and the managers in terms of how they can help the shareholders generate improved returns by hopefully over time narrowing the discount, or at least not letting it widen beyond the point at which you bought it.
Great, thank you. There's one more over here.
Just picking up what James was saying there, I mean, discounts are at historically extremely wide levels. So what can boards and managers do to address that? And then maybe specifically to Stephen with Oakley and Ralph with Apax, what does your company intend to do to try and address the very wide discounts?
Sure.
No, look, the discount, as you said, it's a sector-wide issue at the moment, and to be honest, I don't think there is a silver bullet here. There is a silver bullet, but there is a number of things that a board, a company manager can do. I think a lot is and first of all on returning cash to shareholders. As a fund, the AGA Apax Global Alpha, we have a policy of returning 5% of NAV every year in the form of a dividend back to shareholders. So there is a distribution policy which returns cash to shareholders with a reference to NAV and not share price. Second, I think there is work to be done around engaging with investors and shareholders. James mentioned that the lower liquidity. It's a constant effort, a constant IR effort to broaden the share register, to attract new shareholders into the shares. There is a job to do around transparency of what the investment strategy is. That's why I appreciate discussions like today, which gives us an opportunity to talk about this, but also communicate, what the approach is and what you invest and what shareholders would be buying, and for generally, creating information around the sector, the industry, and the type of investments that we do. As I said, none of that, unfortunately, is a silver bullet. I mean, if somebody knows it, please talk to me afterwards over a coffee. But I do believe, by consistently delivering these mid-teens returns you've been talking about and addressing some of the other issues that I've just mentioned, over the long run, that there should be an opportunity to close these discounts. I mean, as Apax Global Alpha, we've done it twice since IPO. So I'm confident that it's achievable again.
Yeah, I mean, there's nothing I would disagree with there from Ralph. I mean, essentially making the same points. The three reasons I believe is liquidity. We talked about it, it was talked about in the previous panel. It's indiscriminate, the discounts. So it isn't, necessarily a private equity. It probably is a size thing. We're not three on our side. We're kind of in the billion or so size. We're relatively small. So when there are outflows, we suffer like every small and mid-cap fund does. Investment companies have their own particular liquidity issues. How do we resolve that as a first? If the key points are liquidity, transparency, and performance, they're the reasons I would argue you can put most of the points that Ralph raised into those kind of three buckets. Liquidity will come with size in time. These are assets that are growing in size. Also, there isn't a huge amount of supply. There's no incentive for anyone else to really come and provide kind of new listed PE investment trust. So it's us you're stuck with. And so consequently, as yes, that's true. And so I can only assume that demand, hopefully over time, is going to grow for the small amount of companies that are there. And as we get bigger, as we kind of start to populate the FTSE 250, so I think liquidity and fair value will come into that. The transparency point is a really interesting point, isn't it? I mean, it's kind of an oxymoron, isn't it? Private assets on the public market, and this desire to know as much about your private assets as possible. But the whole point and the advantage is that they're private, and that they have that information advantage maybe over their competitors, and that they have the freedom to grow in the way that is appropriate for them. Maybe it is switch to a SaaS model and your earnings halve for the next 2 years, and that's just fine in private equity ownership. It would not be fine in public equity ownership. And so, kind of, it's allowing as much information as possible, reporting as much as possible. We have the big advantage at Apax Global and OCI of being direct. There's only 3 or 4 direct PE investment trusts like ourselves, and that does mean you can see exactly what we own, the companies we own, which you can then go and find more information about. We're relatively focused in the kind of number of companies we're exposed to, and so we're giving more transparency than has ever been given, but we can keep improving on that. And also, outside of this room, there isn't a wide understanding of this sector. There isn't a wide understanding of investment trusts, let alone of this sector. And there's a whole bunch of reasons why, either because how it's talked about in the media, how private equity is understood, how investment understood, is that we have to do a lot of education, as Ralph previously said in the panel earlier, to help a greater understanding of that, and help people understand we're representing a big chunk of the fast-growing economies that you live, work, and invest in, and you're not getting access to that through the public market. So there's a real need to kind of tackle that particular point. And then finally, performance. Look, I happen to believe, like last year, I'm sure Ralph had the same, no one believed our NAV. It was obviously bollocks. And look at the public market, and you're lying to us. Volatility laundering. This year, I think there's a general confidence that, okay, your NAV is your NAV. You've all sold a few assets, you've done it at a premium to NAV, and also the public market's gone back up. So, okay, we're not in the danger zone here. But is P really, you all did well in a low interest rate environment, and you've all, kind of rising tide lifted all boats. Are you still an attractive asset class? That's this year's challenge. Can you really grow? Can you really find opportunities? We hear that there's no debt, you can't raise funds, and there's no deal activity. So is it all grinding slightly to a halt? And so this year has been, no, actually the wheels are still turning, and we've got permanent capital, which is a great luxury, and there's a big chunk of 1 trillion of dry powder sitting within the larger PE funds buying our assets, and I'm sure the same for well. What we now need to prove is we can get through this year and a difficult macro environment into next year and actually prove that performance, that I think you will have a hallelujah moment for PE, because we're still having to defend the GFC, where certain listed PE funds over leveraged, they went under, performance was appalling, and we now need to prove that the current cohort are much higher quality. And I have personally invested across the listed PE space because of exactly that reason. And I think when we go through into next year, I don't think it's going to happen this year. And I personally don't think you buy any listed PE on the basis of their discount. You buy it on the basis of their NAV growth. However, I think going into next year, for a lot of reasons, not just the inflows into public markets, you'll see the discounts close.
That's great.
James, just to add to that from our side, I mean, I totally agree with what the guys are saying. In fact, we look at it and we say, the discounts are driven by 3 things. They're driven by relevance, execution, and messaging, which is kind of what they were saying, sort of shorthand. But for us as shareholders in listed private equity vehicles, I think it's part of our responsibility to engage with boards of these companies to help them understand what decisions they can make that might be beneficial to their shareholders, because those decisions are beneficial to our shareholders. And I think the most important thing is not to set out with this idea that buying shares back is some kind of panacea, that it's a silver bullet, that you're going to buy shares back and suddenly you're going to go from a 40 discount to a 20 discount. That's not the case necessarily. What it is And some funds can't do this as easily as others because of liquidity constraints. But if you think about it as an investment decision, you've just sold an asset within your private equity company vehicle. You have excess liquidity. What can you do with that excess liquidity? And it's quite difficult to argue that buying your own shares back, in other words, buying your own portfolio at a 40%, 30% discount to asset value, is not good use of capital. So it's those sorts of things that boards can do, and alongside the managers, thinking about buying shares back is an investment decision rather than this mechanism to magically narrow the discount. Although there have been a couple of examples in the last few weeks, Pantheon being one, which is re-rated nicely on the back of their quite significant buyback stroke tender. And the other one in our portfolio was Syncona. Syncona was trading on a horrendous discount to asset value. In fact, I was sitting in the board meeting the other day, telling the board about how egregiously mispriced this company was. And lo and behold, the next day they came out and announced that they were buying back £40 million worth of shares. Now, that's not a big deal. It's quite small, but it's a step in the right direction. And the shares were re-rated by getting pretty much 10% over 2-3 days. So, you know, there are things that can be done. So we shouldn't just sit here and say, we can't do anything, all we can do is deliver. Delivering is one part, but, you know, helping shareholders in the meantime is the second part of it, if possible.
Great, thank you. We have run out of time, I'm afraid, sorry. So I think we better move on, but actually, I'm conscious we didn't take any questions from the online audience. So maybe if we've got them all written down, and maybe if you pass your question to this gentleman down here, we can answer those. Maybe just we'd write an article or something that would just cover those points. That'd be great. Thank you very much for your time, gentlemen.
Thank you.
Really good, really good.
Thank you.